Get started. I will take just a minute to introduce Eric to you, and then on with the show. Eric Rosenfeld is a graduate of MIT with his PhD here in finance in the Sloan School, and taught at the Harvard Business School, and was bound for glory in an academic career when Wall Street called him, and I guess you went to Solomon.
Yep.
From Harvard. And the rest is history. He was part of the group which, from Solomon, that broke off and created LTCM. So I'll let him tell the rest of the story.
Perfect. All right, well, just so I get a feel for the class a little bit, how many people had heard of LTCM before this class? Ooh, it never goes away. How many people have read any of the books? Oh, okay, so for people who've read the books, what's sort of your impression, what's your soundbite impression of LTCM? Anybody?
The way that it's written, most people suggest that the risk is the far tail was underestimated.
Yep.
Like the extremely improbable event.
So sort of the black swan, fat tails, we underestimated the probability of these rare events happening. Any other sort of impressions of what went wrong, or just the 2-second sound bites? Well, I guess, the sound bites that sort of stick with me are, this greed and hubris. That's sort of number one. I think there's this outlier theory. There's also this concept that we had just enormous risk and we're out of control. I think there's also these sort of sound bites that over time we strayed into new areas that we just didn't have the experience with and went down because of it. But I think a little more disturbing to me, and one of the reasons I get up here to do these things, is there seems to be this sort of anti-intellectualism tint associated with LTCM, that somehow in a world of human behavior, rational economic thinking and models just don't make sense. And that's something I have a problem with. So I've really put together this presentation to really give you guys the facts so that you can decide what we did wrong and lessons to be learned. And to get through this in an easier way, I've sort of taken a page from Letterman and titled this presentation, "The Top 10 Myths and Misconceptions About LTCM." But before we begin, let me give you a little bit of background. LTCM was formed in February 1994. It was the largest startup hedge fund to date at that time. We raised $1.1 billion, peanuts these days. 100 million plus was our own money, so we were sort of betting with ourselves. And most of the partners of LTCM had come from the proprietary trading group at Solomon under Merriweather. I worked with him since 1984. And here in Solomon's 1994 annual report, they broke out sort of the proprietary earnings from, which came from this group versus the customer trading business. And you can see that in some of the years, more than all of the profit came from, the proprietary trading. It's interesting now that I look at this, Sandy Weil paid $6.5 billion for Salomon Brothers for, for all of this, and then 2 years later, he gets rid of this. Maybe he liked the steady earnings over here. I'm not, I'm not sure. Of course, he's independently wealthy, and I'm here, so what can you say? Oh, and by the way, whereas most of the partners came from Salomon, 2/3 of the partners had an MIT connection. They either had advanced degrees from MIT or they had taught here. So it was a pretty MIT crowd. I know at one point the dean of Sloan, Lester Thoreau, said that LTCM was one of the best finance departments in the country. So at any rate, LTCM started right where we left off at Salomon. We had very high returns. Here are our gross returns. We received fees, a 2% management fee and 25% of the profits. So if you take 75% of this less 2% management fee, you get the net returns to investors, which were also very high. Most people, including the partners, took their profits and rolled them back in. So at the end of 1995, where we had $3.6 billion of capital, we closed the fund to new outside investment and just grew internally. And at the end of 1997, we had $7.5 billion of capital under management, and the partner share of that was $2 billion. Okay, so let's begin. The number 10 myth and misconception on LTCM is that LTCM was massively levered, 100 to 1 or more. True or false? True. If you take a look at LTCM, on the very last day it was in business before the consortium of banks came in, we had $400 billion of equity capital, NAV of the fund, and we had a $120 billion balance sheet. So what is leverage? It's assets over equity, 300 to 1.
400 million you had.
400 million of equity capital, 120 billion of balance sheet. So 300 to 1 on the last day. And, I think the concept is that people equate leverage to risk. So when they make this statement, they're saying, my God, look at the risk of this entity, 100 to 1 or more. They were out of control. Well, we certainly know that leverage does not equate to risk. Clearly, if I had $1 million invested in the stock market, let's say in S&Ps, that's a lot riskier than $1 million levered 10 to 1 in 3-month CDs. What matters is what you own and the risk of that. Well, let's take a closer look at the actual leverage of LTCM over time. And you can see that in the beginning, as we're just building our portfolio, we're kind of in the 15 to 20 to 1. Then, for the longest time, we're averaging between 20 and 30 to 1 leverage. This spike leverage that occurred in the crisis, the 100 to 1 and the 300 to 1, is more of what I would call involuntary leverage. It's not that we're increasing our bets. Our assets are staying the same and the equity is just going to zero. That's what's ballooning the leverage. But typically, our leverage stayed in the 20 to 30 to 1. Here, these dates are wrong. This is 1994, and this is 1998. Here, at the end of 1997, here we've got $7.5 billion of capital. We make a dividend payment of $2.7 billion, bringing our equity to $4.8 billion. It increases the leverage because of it. So we would normally kind of pay a dividend, and then over time, as we made money, our leverage would go down. At the end of the year, we'd pay another dividend, and normally our leverage would have gone down, but here, well, it was the other guys, wasn't me. Okay, so really to examine this idea of leverage and risk, we need to take a look at what sort of business we were in. Our business is what I would refer to as relative value convergence trading. So the concept is to identify cheap assets and try to hedge as many of the systematic risk factors that are associated with those cheap assets, so that all you're left with is the pure cheapness itself. And we would do these trades in fixed income. They could be in the term structure of government bonds. It could be in the swap market. It could be in the equity market. It could be in volatility trades. They were global in nature, and they were across fixed income, equities, and foreign exchange. Now, I'm going to, the next 5 or 6 slides go through an example of a on-the-run, off-the-run bond trade. I'm going to go through it quickly, but the slides are there for you on the website. So let's take a look at this on-the-run versus off-the-run trade. In August of '98, 30-year bonds had a yield of 5.62, and 29-year bonds had a yield of 5.50. Obviously, if you were taking a futures and options class and there was a final exam, you could ask the question, what's the forward rate that equates these two bonds? And you would probably need something like -2 or something, that little forward rate, that 1-year forward rate 29 years hence. So obviously it's not economically rational for these two similar bonds to have different yields. So what's going on here? And I think the answer is that the 30-year bond is much more liquid than the 29-year bond. So the people who own the 30-year bond are paying a liquidity premium, 12 basis points, to own that bond. So obviously people who don't need the liquidity premium, like pension funds, shouldn't be owning this bond. They should be buying the off-the-run bond and getting 12 basis points more. But that's not always the case. And what we would do is we would buy the cheap 29-year bond, 5.62, sell the 30-year bond at 5.50, and try to make those 12 basis points. So what are the forces that bring forward convergence? Obviously one way is you have to hold it for 30 years for it to converge. But typically, this trade converged in about 6 months. Why? Because 6 months from now, the Treasury issues a new 30-year bond. That becomes very liquid, and the old 30-year bond starts to look old and dusty like the old 29-year bond, and the yields come together. How about the risk of this trade? So I go through a lot of stuff here. You can look at it at your leisure. A 30-year bond, the outright risk is about 85 basis points a year. So 2/3 of the time, the yield 1 year hence is going to be 5.50 plus or minus 85 basis points. sigma of 85 basis points a year. Interesting, here's a graph of some of the last 8 histories of on-the-run, off-the-run 30-year bonds. Here, if we go back to 1994, the 30-year bond was about 10 basis points rich to the 29-year bond. It went out to about 13 basis points, and then it converged in about 6 months when they auctioned the next one. Here it starts out at 14, comes down to 2. Here it doesn't really do too much. Here it starts out at 8, goes all the way up to 16, but it then tends to converge. The interesting thing is that the outright risk of bonds is 85 basis points, but if you do the spread trade, the sigma of this is 3.5 basis points. It's 1/25 the sigma when you do the spread. Because the 29-year bond, the 30-year bond, government bonds, no credit risk, are almost identical. They're perfectly correlated. So you get enormous risk reduction by doing the spread. And as you'll see, the biggest risk here is making sure you're able to hold the trade until convergence, that you don't have to unwind it early. And that shows up in some of the slides. I go through some examples of the trade and what happened. Okay, now I think of LTCM as less of a hedge fund and more as a financial intermediary. We're wholesaling risk. We're wholesaling risk by providing liquidity on particular sectors that have some illiquidity, like the 29-year bond versus the 30-year bond. We're essentially selling people the liquidity of the 30-year bond. So I've taken a little bit of liberty here and compared LTCM to Morgan Stanley, and you can see that they're actually pretty close. So here in 1990, that was a mistake.
The bottom, you
Yeah.
press the bottom, and
Right.
just press the top again and it should come back. Yeah.
So here in
Just hit the escape.
that was close. I've had worse times, though, let me tell you.
Committed it to memory.
So very similar balance sheet, 130 billion of on-balance sheet items, similar leverage, because we had similar equity, similar off-balance sheet contractuals, so that would be swaps, over-the-counter options, Forex forwards, things like that. We made a little bit more money that year than Morgan Stanley, and of course a few less employees.
Did Morgan Stanley have prop trading?
Yes. Yeah, that was a part of it. Okay, but the fundamental principle that LTCM was built on was the concept of diversification. In fact, we almost viewed this as a barrier to entry for others entering into our business. We felt that by having so many economically diverse trades, we could afford to put on new trades at lower expected returns than other hedge funds. So you all know the drill in terms of diversification. Let's say we have 9 trades, each with $100 million sigma. Then the sigma of the portfolio of those trades, if they're uncorrelated, goes up by the square root of 9, is 300 million. So let's say we took on a 10th trade, risk arb. So that trade, also let's say with 100 million of sigma, if we take that on, that only adds 16 million to our portfolio risk. This 100 million sigma only adds 16 million of portfolio risk if they're uncorrelated. So here we got into risk arb, which, by the way, it's hard to believe that the spreads between takeover companies would vary depending upon what happens to fixed income spreads, what happens to Japanese equity convertibles, what happens to swap spread trades in Europe. You would think that they're economically diverse and uncorrelated. So here we're getting into risk arb, where we're getting in at times when all the other risk arb funds are getting out. They're saying, is LTCM crazy doing these trades? The returns are so little given the risk. It makes no sense. That's true if you're a monoline risk arb fund. If that's all you do, you get no diversification. You do the trade, you get 100 million sigma. We do the trade, if they're uncorrelated, we only get a 16 million sigma. But if they're correlated, you get no diversification, and that's a problem. Okay. Number 9, myth and misconception of LTCM. LTCM took enormous risk in order to generate high returns. In fact, in the Greenspan memoir, he mentions that what happened to LTCM is that they were going fine for the first 5 years, and then they took on these new risky trades, and that's why they went down. Okay, this is false. And I'm going to prove it to you. This is the monthly risk of LTCM from inception. So our monthly sigma is 4.8% in 94, 3.5% net. So that's the risk that investors see. And you can see that, if anything, it's maybe, well, certainly it goes down early on. Early on, we're just building our portfolio. We're not as diversified. So it's not surprising once we get more diversified that the risk goes down. But you can see, if anything, the risk is probably slightly decreasing over time, probably not significant. And we told investors that we would be providing them with a similar risk of the S&P 500. And, we're pretty close over this period. Now I love this graph. This is my favorite graph. What this is this is every day's P&L for LTCM since inception. So on this day, we lost 150 million. On this day, we made 130 million. On this day, we made 50 million. So this is every day. This is essentially LTCM standing there with its pants down. Everything is out there in the open. If we had somehow put on trades that were riskier, they would show up in the daily P&L. You couldn't hide it. If you look at monthly P&L, maybe it could all work out that over time, over the course of the month, there was enormous risk, but it just lucked out at the end. But this is every day. And this is much more risky than the portfolio really is. Think about it. You have 130 billion of assets, bonds. On some day, the bonds get marked on the bid side, and you lose money. The next day, they tend to get marked on the offered side, and you make money. So this data has massive negative serial correlation, which increases the risk as viewed on a daily basis. So the daily risk annualized is much higher than the monthly risk annualized, because you get a lot of reversals in this data. But you can see that here early on, the risk is low. But don't fool yourself. Remember, the percentage risk was actually higher early on. Here we're still building our portfolio, But here in 1995, once we reach sort of global scale, it's remarkably constant. You slice it any which way, and you get a 45 million sigma. So that might be referred to as a 105 million, 99% one-day VAR. So that's 2.33 times your
VAR
daily
is
sigma.
value at risk.
Yep.
Which
Is reported by the major financial institutions. Okay, so that's pre-crisis. Here, obviously, a little bit more going down. I happen to remember this day. This is Friday, August 21st. We lost 550 million. I do remember this day was September 21st. It was a Monday. It was 551 million, not to be confused with this one. Obviously, a lot more going on here. Okay, the number 8th myth and misconception, LTCM made no disclosures to counterparties, so counterparties had no clue what was going on. Definitely not true. We gave all our counterparties monthly NAV, quarterly balance sheets, annual financial disclosures that included off-balance sheet commitments. Usually once a quarter, the credit departments would come to LTCM and get a full presentation. But really the one thing that they didn't see was this concept of they saw the risk of LTCM as netted inside of LTCM. What they didn't see was that each counterparty had a very different risk than the netted risk within LTCM. LTCM was like a big clearinghouse. But they certainly knew what their risk was with LTCM, and I'm sure they calculated their own VAR with respect to their exposure. Okay, number 7, LTCM went under because it missed margin calls. Definitely not true. We never missed one margin call. You cannot miss a margin call as a hedge fund. That gives the other side the right to liquidate your collateral. Not only that, every other contract cross defaults. So every swap defaults, every repo defaults, every reverse repo, everything defaults. We knew a crisis was coming. Unfortunately, we had the wrong crisis. We thought the crisis was going to be a working capital crisis. That somehow, we didn't think we were ever going to have a risk crisis. We thought that somehow we might not be able to finance our trades and have to unwind them early. That, we're long the 29-year bond and short the 30-year bond. Well, we financed the 29-year bond by doing a repo. We've borrowed money against it. And we got the 30-year bond to sell by doing a reverse repo. We pledged cash and got the bond as collateral and then sold it in the marketplace. We thought we'd have to unwind those, that somehow dealers would come to us and say, we're going to change the terms and now you're going to have to sell your trade out before it converged. So what did we do? We said the first thing we're going to do is we're going to do everything we can to make sure we can hold the trades till it converges. The first thing we're doing is we require our investors to have a 3-year lock-in. These trades take a while to converge. Hence, we came up with the name long-term. And they do. You have to make sure that your investors have the commitment, the wherewithal, to stay with the trades when they go against you. Plus, that makes your counterparties also think that you're long-term. So they think that you're there for the duration, you're not going to get into trouble, and therefore they're going to extend you much better credit terms. Second, these bonds, well, we think they take 6 months to converge. Typically, most hedge funds would borrow the bonds overnight and then roll the financing, roll the repos every day. We said we need these bonds for at least 6 months, so we'll term them in. We'll have a contractual agreement that they have to finance them for us for 6 months, and it can't be unwound. Yes, we'll mark to market the bonds and pass variation margin every day, like a futures exchange, but they cannot tell us they won't finance us. The other thing we did is we made sure we had these two-way mark-to-markets on repos and swaps. That was something new. Swaps weren't always two-way mark-to-market. If you owed margin to the dealer, you had to pay it. If they owed you margin, they didn't necessarily pay it. Because our flows are symmetric, if we're long the 29-year bond and short the 30-year bond, the only time we have to come up with more cash capital is if the spread goes against us. If the market just moves, variation margin goes from one side to the other. And we kept a large fraction of our cash capital in reserve. We happen to get very good haircuts. What is a haircut? A haircut is when I have $1 million of 29-year bonds and I lend them to a bank, they give me $1 million less a haircut. The haircut is to protect them against market movement in case they have to liquidate the collateral early. So typically those haircuts are 1 or 2% for hedge funds and 5 or 10% for individuals. Guess what the haircuts for long-term capital were? 0, because we were a good credit. We were like a dealer when the trading amongst themselves. And finally, we were one of the first people to create some backstop capital just in case. We had $300 million of term debt, and we had over $1 billion of credit lines. And by the way, we knew all about credit lines. As an aside, when I was at Solomon back in the fall of '91, there was a scandal, and the Treasury threatened to pull our primary dealer, which would have meant that we couldn't have financed our positions, which were all financed overnight. We were going under. And that's when Warren Buffett came in, saved the firm, which he did, and I'm thankful. But in the midst of that, Solomon had these massive credit lines that had paid a fee to Chase, JP Morgan, everybody. So we're there filling out the bankruptcy papers one weekend, and I go to the CFO, I say, let's call the credit lines. This is when you need it. This is what you paid, to use them for. The insurance is good, we need it. And he said, we can't do it. People might not fund, and then we're out for sure. Why don't we do this? Let's rip up the old credit lines. Let's go to them. We'll pay them real big fees for some credit lines that are really good. So it was like buying insurance until you needed it, and then it was no good. So as an aside, we knew about this. We made sure there were no no MAC clauses, no material adverse change, where banks could get out of it. We'd also run these little fire drills. Friday afternoon in the summer, 4 o'clock, you call up the banks and say, fund. And, if the guy on the other end said, whoa, 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 what do you need the money for? You knew it was no good. If they just said, sir, yes, sir, and pressed the button, then you knew it was good. Where were we? Okay. Number 6. What happened to LTCM was a perfect storm, a 100-year flood. Somehow, the press got it in the idea that we were going around saying, hey, it wasn't our fault, with global warming or something. Who could have foreseen that this would, we didn't make any mistakes. Well, let's go through kind of what happened, kind of leading up to 1998. First of all, the market has been steadily, the stock markets around the world have been steadily rising. S&P's a lot higher. S&P was around 960, and now it's around 800, so it's a lot higher then. The only problem was, in emerging markets, there was a Thai baht problem, there was a problem in Korea, but the rest of the world is kind of making new highs. And then on Monday, August 17th, something weird happened. Russia defaulted on some of their newly issued ruble bonds. It was a little weird because Goldman had just bought these bonds 6 months earlier, and this was the first coupon payment, and they missed it. Okay, all right, not the end of the world. Also strange that, remember, these were bonds denominated in rubles. All you needed was a printing press. Print out a little rubles, you make a payment. Were there no printing presses in Russia? So that was a little strange. But, we didn't really have much Russian positions, and it didn't really affect markets much. So I got to tell you, on Thursday, I went out to the West Coast for a 10-day vacation with my family, and Friday morning, I made the only mistake I've ever made as a trader. 9 o'clock, I'm at the first tee, waiting to tee off, and I called the office. And it was bedlam. It was Friday, August 21st. We had a risk arb deal, Sienna Tell Labs. Tell Labs was buying Sienna. It was supposed to close that day. It was trading at a 10-cent spread, went out to $16. We lost $160 million on that trade alone. Remember, our biggest loss before this was like $125 million in a day, and the next day it reversed. Swap spreads, which typically move about a basis point a day, were out 21 basis points. We were down $550 million that day, not to be confused with the 551. And, so I shanked a few into the woods and flew home. Okay, so here's a graph of the 10-year swap spread. You can see something very strange is going on. Here's a graph of the daily changes. Obviously, we're in a new environment. Well, at the end of August, we were down about 50%, but it was clear, even though we had about $2.3 billion of capital left, we had way too much risk, and we needed to get back into risk compliance. We needed to both liquidate positions and raise additional capital. So here's a graph of the daily P&L just in 1998. Well, whereas August kind of was this economic crisis triggered by Russia, September was another beast. September really was an LTCM crisis. Were we going to fail? I remember on September 2nd, so this is September 2nd, 1998. This is a little before email, really, took off. We faxed a letter to our investors explaining what happened and talking about the new opportunities. Actually, if you look at any of the Harvard Business School cases, the letter is there. But I thought what was interesting was we had 100 investors at the time and, a couple of fax machines. So by the time we got to investor 50, I noticed that the top story on Bloomberg was us, and they had a copy of our faxed letter that someone had scanned in. So all eyes were on us. We were kind of like this big ship in a small harbor trying to turn. Everyone was trying to get out of the way of us. So if you had similar positions, you didn't want to chance it, you sold them. If, and some people actually tried to bet against us, that we would fail and we would have to liquidate quickly. But I think one of the more prevalent things that took us down was this concept of mark-to-market. So we were short 5-year S&P volatility against being long 1-year S&P volatility. So let me pose a question to you. A crisis hits, the markets are going crazy. What happens to the term structure of volatility on, let's say, equity indices? Well, it goes, which goes up? Yeah, so the VIX, so definitely all volatilities go up, but what happens to a 5-year volatility versus a 1-year? Yeah, it doesn't go up as much. You end up, the short volatility goes up much more, so it becomes downward sloping. If volatility was at 20 and the VIX goes to 50, 1-year volatility is at 40, and 5-year volatility just goes up a little notch because they don't think it's going to last forever. Volatility is going to be more mean reverting. That wasn't the case here. 1-year volatility went to 30, and 5-year volatility went to 42. Why? Because really it was people getting out of the way of our positions. If we were to go bankrupt, the contract goes back to the dealer. So the dealer is saying to themselves, I'm going to be short volatility. Would I rather be shorted at 30 or at 42? I'll just mark it out to 42. If anyone wants to, sell it to me there, so be it. Everyone just froze. But of course, we have to it's mark to market. We have to mark our positions at 42 and send them collateral. Okay, so then on Wednesday, September 23rd, the banks are meeting at the Fed, at the behest of the Fed, and 14 banks put up a total of $3.625 billion, and it's all sort of private money, which leads to the next question. First, so the number 5 myth and misconception is that the LTCM partners turned down the Buffett offer to protect their jobs. Okay, so let me rewind just a little bit. Wednesday, September 23rd, the banks are all meeting at the Fed. At 11 o'clock, we get a call from Warren Buffett. He's on a satellite phone. He's in Alaska vacationing with Gates. And he calls us up and he says, you're about to get an offer from me. I just want you to know it really represents my interests, and I hope you'll take it seriously. A half hour later at 11:30, we get this fax. It basically says that this group, Buffett, AIG, and Goldman, a little interesting, this is John Corzine's signature saying he's going to buy out this portfolio, and yet he's in this meeting at the Fed trying to, well, that's another story. And he's a senator now, so please. Okay, so this group will buy out your portfolio for $250 million. Remember, this is a hard-to-assemble portfolio that was worth $4.8 billion at the beginning of the year, but who's going to quibble over a few bucks? And we don't we don't want any of the guys that were managing this portfolio. You're gone. We don't want any third-party investors. Just wire over your positions, and we'll wire you $250 million. Oh, and by the way, you have an hour to decide. So I have to say, we took this seriously. Bear Stearns had already told us they weren't going to clear our trades anymore, so we were going under that night. So $250 million is worth a lot more than zero, so we wanted to do this. But we actually couldn't do it because we had 15,000 line items of things. You know, long a 29-year bond, repo on the 29-year bond. Short a 30-year bond, reverse repo on the 30-year bond. Long a bond, pay fixed on a swap. You know, everything, all of these are credit counterparty trades. We've done a trade with a counterparty, and to move it to another counterparty, it needs their approval. So obviously, every counterparty would prefer Warren Buffett to about to be bankrupt hedge fund, but how are we going to get this done in an hour? And by the way, Tokyo's closed and we had a lot of trades there. So we went back to the lawyers. By the way, you can see none of these guys is around. You know, some secretary signed this thing. We went back to the lawyers and said, how about this? You take your $4 billion that you were going to invest, put that into the fund. You'll now own 90%, 90x% of the fund. Kick us out as managers. All the financing stays in place. And at your leisure, move the small third-party investors out. The problem is they couldn't get Buffett back on the satellite phone. You know, sunspots. And no one was willing to do a $4 billion deal without his approval. You know, since then, various MBA students have asked him, would you have done the deal if you'd gotten the call? He said, of course. So, would have been a little different. Okay. The consortium investment was a bailout for the rich. I mean, I don't think they were talking about me on the, you know, for the rich. But this has come up a lot lately because did the fact that the Fed bailed us out, did that create moral hazard? Did that create problems for Bear Stearns, for Lehman, for others, by the fact that they took on more risk because they knew that if things really got bad, the Fed was there as a backstop? Okay. Well, I think the answer is very different, and I think the way to answer this question is to look at what the Fed was worried about. So, you know, if you take a look at the risk of LTCM, 45 million daily sigma is nothing. You know, what's 10, 20, 30 sigmas? It's only a couple $1 billion. Who cares? You know, so, but also the risk during the crisis is much more than pre-crisis. Even if it's 3 or 4 times more, it's still a very small number that shouldn't bother. If we go under, there'll be losses, but they'll be manageable. Thinking of LTCM as an entity. The problem is LTCM was like its own clearinghouse. Let's take a look at the 29-year versus the 30-year. That trade has 85 basis points risk aside. 85 basis points of 29-year bonds, 85 basis points of 30-year bonds. The net risk is only 3.5 basis points. The problem is that we didn't do that trade with one counterparty. So if we go under, that counterparty ends up not with billions of dollars of 29-year bonds versus 30-year bonds with low risk that they can take off at their leisure. We broke up the financing. We did the 29-year bond repo with JP Morgan, where we gave them $5 billion of 29-year bonds, and they gave us $5 billion of cash. And we borrowed the 30-year bond from Solomon Smith Barney, where we gave them $5 billion of cash, and they gave us $5 billion of 30-year bonds, which we shorted. They're not paired up. So in bankruptcy, what happens, JP Morgan says, holy cow, I've got these, the bonds, I'm holding these bonds as collateral. I really need cash. I sell out my $5 billion of 29-year bonds. The market goes crashing down. Solomon says, whoa, I got to replace these 30-year bonds that they borrowed. I have to buy back $5 billion of 30-year bonds. So they buy them back. So you're left with not 3.5 basis points, but 2 times 85 basis points. That's what worried the Fed. We had 45 million pre-crisis sigma netted, but with over 15 counterparties, we had 35 million sigmas. 15 times 35 becomes a large number. And then magnitude by the crisis. That's what bothered. There'd be needless volatility as the market sold out, and who would be the losers here? The banks. Yeah.
It's sort of alluded to in the books about long-term capital that the reason why you spread out among several counterparties was to prevent people from knowing exactly what your trades were. Is that accurate?
Yes. Well, there were 2 reasons why we split. We split because we didn't want people to know what the full trade was. So that's one. But also we split because we got better deals on each side. UBS was flush with cash. They were great with repo. Solomon was great drumming up good bonds to lend us. So we did better splitting. That's what worried the Fed. So, in the middle of September, we went around to all the different dealers and explained to them what would happen if we go under. So, we know Solomon well. We go to Solomon and say, we're going to go under. You're going to get killed trying to buy back your reverse repos here. Why don't you make an emergency equity infusion into us, and we can liquidate our portfolio in an orderly fashion. And Solomon goes, yeah, that makes a lot of sense. How about Merrill? So we go to Merrill, same thing. JP Morgan, same thing. This is your classic prisoner's dilemma. So what's the prisoner's dilemma? Police catch 2 crooks. They put them in separate rooms. They tell them, look, if you confess and the other guy doesn't, you'll get 10 years, he'll get 50. If you both confess, you'll get 20 years. But if neither of you confess, you go free. So the solution is, with no communication, when they're in separate rooms, they both confess, because they try to minimize the time they'll spend in jail. But obviously, if they're together in a room, they talk to each other and neither confesses. That was the same situation here. You go to Solomon alone and they go, God, I don't want to do this with everyone else shirking. I'll shirk. But obviously, it's not in their best interest. So the Fed, by getting everybody in a room, that's the communication answer, and nobody could shirk. Of course, Bear Stearns shirked, but that's another. They got theirs, Okay. All right, the number 3 myth and misconception is that LTCM is facing lawsuits. Actually, there was one lawsuit that was filed. It actually wasn't against us. It was against the banks as some sort of conspiracy to take us under. You know, it went nowhere. Maybe one of the answers for why we weren't sued was because only 12 investors lost money, and only 6 investors lost more than $2 million. Of course, those 6 lost a lot. I mean, UBS lost $1 billion here. And actually, the median investor, the guy who invested at the beginning, and you know, so a guy who invested at the beginning, he had $100 at the beginning of '98. It fell to 8 cents when the consortium came in. We magically got him a 25% return all the way up to 10 cents, paid him out. That guy still, including his 90% loss, made a 19% internal rate of return. Why? Because we had such big profits and paid such big dividends. The consortium, who thought they were going to lose their entire $3.6 billion investment, they were actually up 25%, decided to liquidate a little sooner, and they ended up with about a 10% rate of return. The partners, unfortunately, their $2 billion, 0. Actually, maybe even a little negative. It happens.
Can I ask you a question?
Yep.
What made you guys not put any of that outside of your fund?
Have you been talking to my wife?
I'm really curious.
Yeah. I got, you know, maybe it's the Bernie Madoff story, that we Madoffed ourselves. You know, when we look at our returns, we had 60 months, we had 4 down months, we had no back-to-back losing months. Our largest drawdown was 2.7%. So, and our money, not like investors, could be pulled monthly. So, so I viewed it like a enhanced checking account. You know, you need to buy a new car, pull some money out. You know, it was no problem. So, so we didn't view it as very risky, and we were earning 40 to 50%. Actually, it's interesting. We charged 2 and 25 to outside investors, but we had internal fees that we sort of charged ourselves to make an investment. They were higher than we charged outside investors. We thought it was a better deal. But then, of course, when the crisis hit, and a lot of people had even borrowed money to put more money in, they said, hey, you know, can't I just pull out some money to pay off my loan, or to pay off my mortgage, or, you know, to make some college payments or something? Nothing. I mean, you couldn't allow your money to get out and the other people to stay in. So we thought it was like an enhanced checking, but it wasn't. Okay, I love this one. You know, the LTCM partners don't admit to making any mistakes. You know, we lost $4.5 billion, but it, you know, wasn't our fault. Okay, all right. So let me talk about two types of risks that I think were not as well known. The first I call endogenous risk. You know, the fundamental principle that LTCM was built on was this concept of diversification, that by having so many economically diverse sets of trades, we got an offset. You know, people have said, oh, that's not true. You were short liquidity, and this was a liquidity crisis. But that's the soundbite answer. Most of our trades were sort of short liquidity, long liquidity. We were We were short UK swap spreads at 60, long European swap spreads at 10. So normally in a crisis, a liquidity crisis, swap spreads go out. There's a liquidity premium. Treasuries sell at a premium. But in this case, the 60 that were short went to 140, and the 10 that we were long went to minus 10. This was not a flight to quality. This was a flight out of these relative value trades. There was a common thread in all of our trades, our mortgage arb, our fixed income relative value trades, our equity relative value trades. The common thread was not liquidity. The common thread was that they had similar owners of the trades with similar risk preferences and tolerances. And when Russia triggered a risk reduction, managers said, let's get out of these relative value trades. And that pushed the spreads out. And then they said, whoa, we got to reduce risk even more. And that pushed them out. People didn't have all of our trades. Everyone had a little of them, and they were taking them off. The trades were not economically related, but the correlation came through by the people who were holding the trades and all liquidating at once. So more of what I would call endogenous risk. I think that's a key element that, that gets missed. The second, and this one I'm a little surprised we missed. Well, I guess I'm surprised we missed that. We set up long-term to look exactly like Solomon. Same size, same scope, same types of trades, same everything, because it worked for 10 plus years at Solomon, and it was working at long-term. But what we missed was that there's a big difference between the two. Solomon's a monoline hedge fund. I mean, long-term's a monoline hedge fund, and Solomon is a lot of different businesses. They got internal diversification from their other business lines during this crisis, so therefore they could afford to have taken on more risk. We should have run this at a lower risk. Okay. Let's move on to number one, and then we're going to get to some plenty of questions. Number one myth and misconception is that the LTCM partners have retired and are out on the golf course. I wish. Well, we thought it was going to take 3 years to liquidate LTCM. It actually took about 15 months. The liquidation actually turned out very well. We didn't have this, midnight Kmart liquidation where everything must go. We had this sort of prepackaged bankruptcy where the consortium came in, they took over the board of directors, gave us a new mandate of liquidate in an orderly fashion, and it worked. And on the very last day of LTCM, Merriweather and about half the partners started up a new fund, JWM Partners. I went with him. Myron Scholes and the other half went with Oak Hill. Very similar, very similar strategies, similar to what we were doing at LTCM. Obviously, different risk management, which we'll get into in a second. It's interesting. This last one. Globop. People were so impressed, not with us, but with our back office group. We never missed a margin call. We were in total control. People used to come to us and say, what are our positions with you? Because we knew what was going on. So they were so impressed with that group left, started a hedge fund back office firm, and it's worth $550 million market value now. I missed my piece in it somehow, but that was a positive story. JWM and Oak Hill did, very well up until last year. They were averaging kind of low teens with about a 3.5% sigma, and JWM got up to about 4 billion. Oak Hill got up to about 6 billion, and last year they were down over 40%, and I think they're both going to be out. So, all right, so let's talk a little. Let me just give you a couple of potential lessons to be learned, and then we'll open it up for questions. The first thing, I think it does make sense to be more transparent. That if people had an idea of how large we were, especially this concept of not being paired, they wouldn't have extended the credit that they did to us. Obviously, we were worried about too much of our positions getting out and people copying them. I think there have been a number of financing changes that the banks pushed, some positives, some negatives. The positives are the trades tend to be paired now. They almost won't do the trade with you unpaired, and they'll give you better terms if it is paired. So that's a positive. A lot of these banks put in triggers. If you're down X% in a month, a quarter, or 6 months, we have the ability to unwind our trades with you. That feels systemic to me. I think that's potentially bad. Okay, so I think we should also, let me just mention, and then we will open it up for questions, that there was a lot of talk about comparing LTCM to Bear Stearns and Lehman. And should the Treasury have bailed out Lehman? And my contention, and I have a slide on this which you can look at your leisure, is that the Treasury was looking at Lehman's net risk. But Lehman had enormous unpaired trades. Think about this. They might have had very limited, let's say, CDS exposure on IBM. They might have bought CDS protection and sold it, so their net position was low. But in bankruptcy, both sides have to scramble. They might have had a very mitigated fixed income swap position. They pay fixed over here with this customer, they receive fixed over here. All of it nets. None of it nets in bankruptcy. As soon as you can follow the crisis directly to the filing on Monday, September 15th, it set off a crisis not in the equity markets, but in the fixed income markets and the swap markets where Lehman, I think the Treasury missed this pairing concept. We should open it up. And now, the ground rules are you can ask any question. I think the number one question I get is, exactly how much money did you lose in? My wife reminds me of that one. Yeah.
How did over time the types of trades that you were doing change? There's a lot more people got into the business, so the spreads were narrowing.
Well, I have to say that the trades themselves, they kind of remarkably come in and out. If I look at the trades now and say, how do they compare? They're so good. You go back to like 1984 on some of these trades. They're just amazingly good. But if you go back to 98, clearly one of the reasons we did so well was because those trades had gotten pushed in. But I look back, I would love to be doing trades that I did back in 1984, right now. Great bonds versus futures. And clearly we know the reason why, qualitatively, why it exists. People are just not providing the financing for government bonds. Yeah.
Do you think that complex financial engineering products are going to make a comeback in the near future?
Well, no. I mean, not in the near future. I mean,
With improved risk accounting?
I don't think there's any way in the next couple of years that you'll be able to raise money for quantitative, complicated trading strategies, especially if they require leverage. I mean, I think this type of investing is broken in its current form. Now, that doesn't mean that you can't do it in another form. For example, you take the techniques of hedge fund investing and you don't do it in a levered way. You go to a pension fund and you say, you're owning these government bonds, sell them and replace them with futures, pick up 4%. You know, that type of thing. You do the quantitative investing in standard unlevered asset management. You, rather than buying cheap things and selling rich ones, you just buy the cheap ones. There are plenty of them out there. Should we give them the final example?
Actually, one.
Yep.
So you mentioned GWM's down 42%.
Right.
And similar strategy to long term. What do you think are some of the parallels, or is it just one of those, again, like perfect storm scenarios that it's hard to model for? Or it seems, I mean, I guess the general criticism is that same guy, different fund, same result, right?
Right. And no, I think it's broken. I think that strategies that require leverage, I think holding them in a hedge fund form does not work. I mean, you just can't operate 9 years great, 1 year out of business. You know, that doesn't work. So I think there needs to be a different structure. They came up with a different risk management technique that they thought would protect them. It was pretty inefficient, but it still got them, you know, a great Sharpe ratio. But no, I think it's broken, and that's mainly, I mean, yes, they're down 40%, they're not continuing. A lot of it is because they think the strategy itself is broken in the way that they were running it. Yeah. Yeah, sure.
I was going to say, has there been, I'm sure there's been a lot of research done since everything happened in '98 on what would have happened had there been more capital, or had you guys had less leverage and it carried out for, you know, another year, 6 months, whatever. What would have happened? I mean, there's not like a definitive answer, I guess, but if things had been allowed to settle, and is there some price floor of capital that you guys would have had to let things continue out and make profit later, or some minimum leverage that you could have foreseeably had, and then over time it would have worked its way out?
Yes. I think that there were two crises. There was the economic crisis, and then there was the LTCM. Did we have enough capital to make it? I think if we had enough capital to make it, we would have only lost in August.
How much capital would that require then?
Maybe 2 or 3 more billion. I mean, but I'm just saying, well, you know, I wonder if we hadn't given back the 2.7, that might have been enough. But we would have gone down later because the risk management was wrong. The risk management managed to the sunny days. You have to manage to the bad days. And we were not there. I think the only way to be there is to run the fund very different, not 30, 40%, but more sort of LIBOR plus 1 or 2. And we were nowhere near moving in that direction. So I think 98 didn't hit, it would have been something else. clearly '08, if we had made it. Wow. I thought '98 was bad. Orders of magnitude. Orders of, the worst case scenario on this spread, out 100 basis points, out 900 basis points in '08. I mean, it's night and day. Yeah.
Yeah, what do you think the hedge fund industry is then today? Where do you think it's going? I think some of us are going to work in hedge funds, so what advice could you give us?
Good luck. Well, I think the hedge fund business is going to change dramatically. The first thing is, I think it'll consolidate. I think the big actually will end up getting bigger because people just don't want to give money to a small guy. They're worried that he's going to skimp. He could be a Madoff. I mean, it's lots of things. Whereas if you give it to a big guy, they have a good track record. I just think the big will get bigger. I think it's going to be much harder to pursue the strategies the way you have in the past because you just can't get leverage anymore. The banks, if they're going to loan money, they're going to loan it to consumers, not to hedge funds. So that means that, well, it's good news and bad news. It's going to be harder to get the really high returns, but it means that the standard run-of-the-mill returns are going to be much better because people are not arbing them in. So I think it actually is a good business, but it's going to be more consolidated. I think the fund-of-funds business is pretty broken. Here you give money to these guys and they route out the good hedge funds. You're paying them to do your due diligence, and yet they end up with Madoff and all these others. So that feels pretty broken. Yeah. Oh, yeah.
I was going to say, what about the new consortium clearinghouses?
Yes. So I do think that that one great thing that could be done here to eliminate this pairing risk would be to have a clearinghouse for these off-balance sheet items, like a futures exchange. Refco went under. Remember Refco, well, I guess there were some dicey things there, but in any event, they had kind of two businesses. They had a futures business, and then they had an over-the-counter business. The people who did over-the-counter trades with Refco lost 80 cents on the dollar. The futures traders that had their money in a clearinghouse lost zero. If the Refco trades had been done in a clearinghouse, there'd be no problem. If the Lehman trades were done in a clearinghouse, there would have been no problem because there wouldn't have been this paired problem because the pairing would have been paired inside the clearinghouse. It's funny, they recognized this a little bit the year before Lehman went under. And rather than having a clearinghouse, which didn't exist at the time, Lehman went out and wrapped their swaps with a credit counterparty. A pristine counterparty to make good on all of their contractual, a AAA counterparty, AIG. So, yeah.
In our curriculum today, we learned a lot about the fallacies of kind of theories of yesterday, things that efficient markets don't exist or that normal distributions don't really explain the world. And as someone who's kind of come from academia that's been a practitioner for many years, is there advice that you would give to us today while we're in school and certain things that we should be particularly skeptical of, kind of the academic theory as we kind of go through these next few years?
Well, I put myself in the efficient markets camp, even though everything I do is, I think that in the micro there might be some inefficiencies. I mean, what do we mean by efficient markets? I think what we're saying is we can take the signals from market prices and use them to make decisions. If it were just chaos, you couldn't use them. So I think markets are sufficiently efficient to do that. I mean, what are we talking about? 560 versus 550? You know, that's small. But in general, you know, the concept that interest rates are 5.5% we can use.
Are there other disciplines that you think, you know, we should be particularly skeptical of, though, or maybe the way we think about risk, or I don't know.
Well, yes, I do think that my advice to you is we have a lot of models out there. And I've seen guys out there just use models. And the model says this. Let me tell you one story. This was when we first started LTCM. In 1995, the Japanese came out with a really weird security. It was a preference stock with a floor and an out and a this. It was like a modeler's nightmare, you know. So that fell in my lap. That was sort of my area. And I had a couple guys working for me. One guy was this rocket scientist, I mean a real rocket scientist. He's Caltech, physics degree. He was referred to us by the former dean of Sloan, was dating his daughter, you know. This guy's, you know, he started out like at a $50,000 salary and he was making like $500,000 in a few years. He was going gangbusters. He was a terrific coder. I gave him the problem. And he just brute forced it, threw it into a model. It came back to me, just trash, you know, negative stock price. It made no sense. You know, I give it back to him, I just get garbage because he's just purely mathematically modeling it, not thinking about it at all. I remember Merriweather came to me. They'd been trading these things for 2 weeks and we weren't trading them yet. And I said, look, I got my best guy on it, you know, and he said, how about yourself? Why don't you do it? And I go, oh, I don't want to do that. So I gave it to this MIT undergrad we had just hired. Paul Asquith recommended him to us. Love this kid. He had worked for Paul as a research assistant. He was just an undergrad. I gave it to him, and I figured out it'd be a week. He came back that afternoon, and he had a solution. It wasn't a great solution, but what he had done was he had bounded the problem enough for us to get going. And he said, it's going to work in this region. It's not going to work outside of that. But we were currently in that region, made a lot of intuitive sense. We did it. We later solved the full problem. It did go out of the region, but we were ready for it. So I think the answer is, if you use these models, you got to know where they work and in what region they don't. It's interesting, after the crisis, the rocket scientist goes off to DLJ, you know, 500-600 grand. You know, he rebuilds all our models there. And then they say, well, how about the next set of models? And he goes, whoa, don't know how to do that. So he goes to Morgan Stanley, rebuilds our models there. Then he goes to JP Morgan. He's sort of going place to place. The kid ends up, he's managing a $6 billion portfolio, and he's the CIO, the Chief Investment Officer of a $30 billion hedge fund. So I think the answer is, I care less about the mathematics and more about the intuition and the curiosity. I don't know how I got into that one.
That's good. Well, you have to end with a story.
Yeah, okay.
Thank you, Eric.
Yeah, that one, we rambled a little.
The release forms that you sign, that's a formality that Sloan School requires. Just leave them up here.